Hi there. As part of your study of financial economics, it's important to be able to understand some of the consequences of instability in financial markets. So we're going to spend a few minutes thinking about that in this session. So it's important to note that financial instability has both an economic consequence, indeed an economic cost, but also a social cost, and that's an important evaluation point to make in an answer. I really like this quote from the Bank of England, which comes from their Financial Stability Report, which is published twice a year by the bank. Financial stability, public trust and confidence in institutions and markets and infrastructure and the system as a whole is critical to a healthy, well-functioning economy. So the Bank of England clearly believe that it's important to maintain stability in the banking system in particular, in part to maintain confidence and trust in the wider financial sector. So why is instability costly? First of all, it creates a situation where people lack confidence. If businesses, for example, are not sure whether they're able to get a loan to fund their expansion, financial instability can lead to less business investment. People are worried about their jobs and worried about the state of the economy as a whole. That leads to more precautionary saving, which lowers consumption and aggregate demand. And when you have volatile asset prices, such as in particular volatile housing prices, people have borrowed extensively to fund a property or mortgage, then that can lead to a fall in consumer wealth and spending. Crucially, when you have instability, the social capital in the economy tends to decline. There's a loss of trust in institutions. And typically when trust goes down on behalf of the lender, for example, if they're not confident that the borrower can repay their loan, then typically when there's less trust, people have to pay more interest on loans, for example, to businesses. And that makes it harder for emerging businesses and startups and medium-sized enterprises to get the funding they need. It's also more expensive for people to borrow money as well. For example, payday loans, extremely high interest rates. It's also important, I think, to link financial instability to inequality, to the distribution of income and wealth. There is quite strong evidence that during periods of recession, poorer communities, vulnerable households, tend to suffer more. And therefore, if financial instability leads to a period of recession and slow growth, that can have a damaging effect on people's living standards, particularly in families of average or below average incomes. And we've also seen in the aftermath of the global financial crisis from 2009 onwards in particular, we've had 8 or 9 years now of extremely low interest rates. Policy interest rates set by central banks have been low, designed of course to bolster confidence and maintain spending in the economy, but one of the consequences of that has been that the real incomes and the real interest rates of people with savings have suffered as a result. And millions of people who rely on the interest from their savings to fund their lifestyles have been hit by that. So let's bring some thoughts together on this. What are the economic and the social costs from financial instability? Pick out 5 or 6 of them for you. One aspect, of course, is the cost of bailouts of the banking system. Hundreds of billions of pounds and dollars have been spent bailing out failing institutions. Ultimately, the taxpayer bears some of the cost for that. Depositors are also at risk during periods of financial instability. They're at risk of lost savings if banks go under. There is a depositor protection scheme in the UK which provides a degree of protection for people, but people with savings in Italian banks and in Greece, and in particular we think in recent times in Cyprus, have found it very hard to withdraw their cash, and the banking system has been extremely fragile. Creditors, of course, suffer in financial instability, particularly when the level of unpaid debt goes up. So the level of non-performing loans, for example, it becomes a problem for banks. Shareholders may lose equity if share prices fall, although of course they've taken a risk in buying the shares of banks. Lost jobs. One of the aspects of the consequence of the recession and the crisis was, of course, banks shed jobs, and other institutions. There's been a big fall in employment in many parts of the financial services sector and related industries, of course, because of the negative multiplier effects. And the government loses out because they're getting less revenue from financial institutions when the sector goes into crisis, and the cost of the bailouts adds to the debt as well as to the annual deficit. So financial instability for an economy can bring some quite significant economic and social risks. Joseph Stiglitz, Professor Joseph Stiglitz, the Nobel Prize winner, has been a well-known critic of financial markets, and in particular the light touch regulation of commercial and investment banking in the run-up to the crisis. There's a lovely quote here that the 2008 crisis showed that markets on their own were neither efficient nor stable. Great quote there from Stiglitz. Big losses stem from inadequate banking regulation, and the economy, according to Stiglitz, was only saved and was only avoided depression through massive government intervention. According to Stiglitz, there's an irony here, that actually the light touch deregulation of financial markets was an attempt to reduce the role of government, but actually ultimately it led to an increased role through nationalisation and the bailout of the banks. According to Stiglitz, it's now widely understood in mainstream economics that the perfect markets model, the efficient markets model, is not robust. And indeed, something we're going to touch on in another video, that slight imperfections in markets, slight market failures, can have large systemic consequences. Stiglitz is saying here that financial instability creates negative externalities. So we focused on the macroeconomic cost, but also you could also bring in an externality idea, which of course is from microeconomics. So financial instability has both economic and social cost. It's important for central banks and for governments to try to maintain financial instability, and we'll have a little bit a look at that in a future video, part of our series on financial economics.